For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to Debt Snowball, Debt Avalanche, Velocity Banking. Real quick about my credentials: I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For debt, this person have a Chase credit card, Wells Fargo credit card, Region Preferred personal line of credit, PenFed personal loan. Okay, the credit limit $8,400, the APR $2,650, the balance owed $8,000, monthly payments charged $302.40. Okay, that's how much they're being charged currently on that account, $302.40. The availability, we've learned on lesson 1, America, that the availability is the relationship between the credit limit and the balance owed. And that relationship calls for a subtraction operation. So 8,400 minus 8,000, that's how we arrive at $400. Okay. Credit utilization is the relationship between the balance owed and the credit limit. That relationship calls for a division operation. 8,000 divided by 8,400, that's how we arrive at 95.24%. Okay? Payment rate charge is the relationship between the monthly payment charge and the balance owed. That relationship calls for a division operation. 302.40 divided by 8,000, that's how we arrive at 3.78%. Okay? Now, on the Region Preferred personal line of credit, it is a 2-3 personal line of credit. So 5 years total, but the first number is the draw period. The next number is the repayment period. So 2-year draw, 3 years repayment. And right now we're on year 1 of 2. So we're still in the draw period, okay? Now, as far as the monthly payment, this Region Preferred personal line of credit, the lender wants principal and interest. Because remember, from prior lessons, we talked about how these accounts are not always interest only. This one, Regions required principal and interest payment, okay? And the principal interest payment has to be $50 or 3%, whichever is greater. So $50 or 3% of the balance, whichever is greater. That's how much the monthly payment charge is going to be, okay? Now, on the PenFed personal loan, right now we're on year 4 of 7. So it's a 7-year personal loan. We're on year 4 of 7. Okay? Now coming down with some more items. The income, $3,000. The expense that this person has is $2,686. Out of the $2,686, $820 could go on a credit card. Because some of these expenses, you could pay them with credit card, but only $820 could go on a credit card, okay, out of the $2,686 of expenses. The debt is 31,800. The debt, that's when you add all these balances, 8,000, 5,000, 15,000, and 3,800. That's how we arrive at 31,800 for debt. And cash flow, we've learned from prior lesson that the cash flow is the relationship between the income and the expense. And that relationship calls for a subtraction operation. So 3,000 minus 2686, that's how we'll have at 314 bucks in cash flow. Okay? All right, question posed to me was, James, can you go over some of the issues that we might come across while attempting to change the due date? Okay, and also, can you run your method against the other method? Can you run your method against Debt Snowball? Can you run your method against Debt Avalanche? Can you run your method against Velocity Banking for 1 month only? Okay, America? I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. All right, America. Now, let's go over some of the issues that you might come across while attempting to change the payment due date. Okay? We know for some lenders, for some creditors, from prior lesson, when we're trying to use an alternative account, and 99% of the time, it's advisable to change the due date. And we're trying to move our due date towards the end of the month, okay? And for the folks who are gonna be using automatic payment, we prefer that due date to be on the 28th. If you're not gonna use automatic payment, then you could pay it on the 29th, on the 30th, on the 31st. Depends how many days that the month has, okay? Now, for my method of for paying debt in general, changing the due date is not a requirement, okay? But we said from prior lesson that it is highly, highly recommended. Not a requirement, but highly recommended, okay? For example, we have Capital One. What are some of the issues you might come across with Capital One, okay? Now, I don't know if that is true for every credit card that Capital One has, but at least for, I believe it was a Capital One Quicksilver, I believe it was, that this was some of the issues. When you're trying to change the due date, say for the 28th of the month, 2/8, when you call Capital One, okay, at least in the past, I don't know if they changed their policy since then, these were the available date that you could choose from, okay? And they were the 4th, the 8th, the 15th, or the 19th, okay? You couldn't pick any other date. So if you're trying to move to the 28th, there's no 28 in here anywhere, okay? So you have to pick one out of these 4, okay? Now, in a situation like that, James, which one then should I choose? Okay, because we have the 4th of the month, the 8th of the month, the 15th of the month, and the 19th of the month. Okay, so for a situation like that, you have 2 choices. Okay, we're gonna concentrate on the first day that's listed, which is the 4th, and we're gonna concentrate on the last day that's listed, which is the 19th. The ones in the middle, do not use them, okay? Do not use the 8th. Do not use the 15th, okay? Now, it's totally up to you to pick either the 4th or the 19th, okay? So why the 4th, James? Let's start with the 4th first. If you pick the 4th of the month as your due date. Okay? Remember, we prefer that our due date is towards the end of the month, but the 4th is not towards the end of the month, that's towards the beginning of the month. Okay? So in a situation like that, you could still pick the 4th, but you have to instead pay the bill early. Okay? If you choose to pay it on the 4th, to change the due date to the 4th, okay, remember the middle one are no-goes. Okay? So on the 4th, so pay the bill early, which means, say for example, we're in February, and you pick February 4th, which means that you're gonna have to pay that bill in January. So you have to pay early a few days prior. So it would be the following month. Okay, so it will be January. Okay, so even though it's due on the 4th, trying to pay it early. That way you still achieve your 28 due date, or your 29 due date, your 30, your 31. Okay, so you're gonna pay it a few days early. Okay, if you have auto pay, for auto pay we prefer the 28, but if it's not gonna be auto pay, it's to where you're gonna manually, actively pay it yourself, then you could pay it on the 29th, you could pay it on the 30th, you could pay it on the 31st. Again, before the 4th, before the following month, because it's due on the 4th. Okay, so just pay it early, a few days early. Okay, now that's if you choose. It's totally up to you if you choose the 4th. Now, if you choose the 19th, remember the 8th and the 15th is a no-go. Don't choose those, don't pick those. So the 19th, that's fine. If it's on the 19th, say February 19th, so you're gonna pay it on February 19th, okay? So at least it's not towards the beginning of the month. It's kinda, towards the end, but not quite. Because remember, we're trying to achieve a 28 due date if we're gonna be on auto pay. If not, 29, 30, 31st due date. But they're not allowing us to have the 28 due date that we want. Okay? So these are the choices. Do it, pick the first number, but in that case, you're gonna pay the bill earlier, and you have to be consistent now. So every other month, you still pay it earlier, a few days earlier, okay, for the month prior, okay? If it's gonna be on the 19th for that particular example, then you pay it on the actual date, which is the 19th, okay? So that was for Capital One. Now, for Regent Visa Signature, okay? And as you could see so far, they are not allowing us to pick the due date that we want. We want the 28th. These were the date that they gave us. Now, on Regent Visa Signature card, I come across a scenario whereby the due date was on the 13th, and you're trying to change the due date to the 28th. If it's going to be on auto pay, automatic payment, okay? And for the Regent Visa Signature, you will come across a scenario whereby they're telling you that you can only advance it. You could only advance the due date by 10 more days. Okay? So it was due on the 13th, which means the most you could change it is 10 more days. So that means 13 plus 10, you could get the 23rd, okay, as a due date, okay? These are some of the restrictions that the big bank, the big creditors are putting on us when you try to change the due date. And again, as you can see, they do not want you to have the due date that you want. Because at every turn, they put in roadblocks at every turn, at least some lenders, okay? So it's due on the 13th, you can only advance it by 10 more days, which means the latest due date that you could get is the 23rd of the month, okay? All right. And again, I don't know if that is true for every credit card that Regions has, but at least that was some of the roadblocks and issues that we came across, okay? Now, let's move down to T-Mobile Internet, okay? T-Mobile Internet, these folks, these creditors, this company will allow you to have the 28 due date that you want if you're gonna do auto payment. However, they are telling you that the draft date could only be on the 26th. Even though you could get the due date that is the 28th, but they're gonna draft the payment 2 days prior on the 26th. On the 26th. You could get your 28th due date, but the draft date gonna be on the 26th. Okay? So, in a situation like that, America, you have to decide, do I want to get the 26th? And sometimes they only do that, it depends on what type of payment method that you're going to use. If you're going to use a credit card, well, for T-Mobile, it's no matter what kind of payment you're going to use, it's going to be the 26th. But for some other companies, when they change, when the draft date is a few days, 2 or 3 days prior to the due date, it's usually depends on the type of payment that you're using for automatic payment. For example, if it's a credit card, they're going to want to draft a few days early. That way, according to them, they're giving themselves time to process the payment, okay? So, but for T-Mobile, that's not, I don't believe that was the case for T-Mobile. I think for, regardless what type of payment you're gonna use, they're gonna draft it on the 26th, which is 2 days prior, okay? So in a situation like this, you have to decide, do I wanna have automatic payment, which gonna be on the 28th, but that automatic payment, well, the due date will be on the 28th, but the automatic payment gonna be drafted on the 26th. So in essence, you're gonna lose 2 days. Or do you wanna pay the bills manually yourself? That way you achieve you don't lose no 2 days, you still achieve your 28th due date, okay? So 2 choices in a case like this. You could have automatic payment, where it's gonna be drafted on the 26th, so you're gonna lose a few days, 2 days in this example. Or you could say, you know what? I'm not gonna use automatic payment for this particular scenario. I'm gonna pay the bill myself. In this case, you're gonna pay it on the true due date, which is the 28th, okay? So it's totally up to you, because remember, you're gonna be the one implementing the solutions, okay? So you have to figure out which one's gonna be the best options for you. If you're somebody who is not that disciplined, you think you might forget to pay the bills on the 20th. If you're gonna do it manually, then in a case like this, go ahead and do the draft day and lose the 2 days if you're not disciplined, okay? Because you're busy with life, okay? Running up and down, you know, trying to do different things, okay? And you think you might forget to make the payment, okay? We don't want to be late. So in this case, in a situation like this, you might choose to grab the draft day, which is the 26th, and ended up losing 2 days in the process. Because the 28 minus 26 is 2 days that you're losing, okay? For paying it on the 26th instead of the 28th, if it's going to be automatic payment, okay? But if you think you're disciplined enough to pay your bill on time, go ahead, do it manually. No automatic payment. Do it manually, pay it on the 28th. Okay? Now, another roadblocks. Again, there's issues everywhere. Every turn you make, there's another issue when you're trying to change the due date. As you could see, they are fighting tooth and nails, okay, for this due date. They don't want you to change the due date to the date that you want. If you have a home equity line of credit, okay, these, whatever origination date that was issued when you have the home equity line of credit, that is the due date that you're stuck with. For example, if when you first get the loan, the due date was on the 17th, then you're stuck with the 17th. You cannot change it. If when you first got the loan, you was due on the 14th, then you're stuck with that date. Okay? So there's an opportunity then when you, at inception, when you first get the home equity line of credit, at that time you might ask them to change it to the due date that you want. Okay? Because if you wait a little later, it's too late. You can change it. Once it's set, from the origination, once they set the origination date, when you first get the ELOC, you're stuck with whatever date that they're giving you. Okay? So if you want an opportunity to negotiate, it'll be before, okay, the date is set. Okay? That way you could get the due date that you want. Okay? So that was on the ELOC. On mortgages, okay, normally the mortgage are due on the 1st, and some lenders allow you a grace period. For some lender, it could be due on the 15th with the grace period. It could be due on the 16th. It could be due on the 17th for some lenders, okay? And same thing, you could choose the last day, just like Capital One credit card. So you could choose to pay it on the 1st. In this case, you're gonna pay it a few days early. You might choose to pay it the month prior, okay? So again, for February 1st, you could choose to pay this bill early, pay the mortgage early. So you pay the mortgage either on the 28th, on the 29th, on the 30th, on the 31st, okay? That's how you achieve at least your 28th due date. So you're gonna pay it early, just like we've done for Capital One in this particular example, okay? So that's one option. The next options you have, whatever grace period that they allow you, if it's the 15th, then you're gonna pay it on the 15th. That's your other options. If it's on the 16th, then you're gonna pay it on the 16th. If they give you grace period all the way through the 17th, okay, if you have that kind of grace period, then you're gonna pay it on the 17th, okay? These are some of the options that you have, okay? So for some bill, you might decide to pay it early, and pay it the month prior, so you could still achieve your 28th due date, your 29th due date, your 30th, your 31st, or you might choose to pay it on a later date, whatever the latest date that's allowed, okay? That's how you do that. And finally, we have some bills that do not have due dates. They're still bills, they're still expenses that you have to account for, but they do not per se have due dates. For example, if you put in fuel in your vehicle, you put in gas in your vehicle, well, there's no due date for that. If you dining out, going out to a restaurant or something, there's no due date for those. They are still bills, they are still expenses that you have to account for, but there's no actual due date for those. If you're gonna buy your groceries, same thing. You still have to account for them, but there's no due date for those, okay? In a situation like this, remember, we want the income to remain in the alternative account, okay? For as long as we want more income to remain, that way the balance will stay low. In a situation like this, you might choose to break it down. In the case of fuel, for example, gas for your vehicle. So you could break it down, okay? Say you put, well, let's do dining now because it's a little easier. Say you normally dine at two separate restaurants during the month period, okay? And let's call it restaurant A That's a more cheaper restaurant. Probably cost you, I don't know, say cost you 110. Okay? In restaurant B, the bills usually come to around, say, 200 bucks. Okay? Or whatever the amount is, okay? So, in a case like this, totally up to you, okay? Remember, in the alternative account, we gotta be a little stingy. So we want the smaller expenses to come out first, not the larger expense. So in this case, you might choose to dine out at the cheaper restaurant first, and you reserve the more expensive restaurant, whatever the amount is. I'm just using this as an example. Could be 80 bucks, could be 500 bucks, doesn't matter. The cheaper restaurant first, you know, and the expensive restaurant towards the end of the month, okay? If that would help you, okay? And again, I'm not telling you how to go about your day-to-day life, but remember, we're trying to have more income remaining inside the alternative account for longer. So for that reason, we don't want expenses, too large of an expenses to go out first. We want smaller expenses to go out first. That way more income stays in the alternative account. Because the lower, remember, the lower the balance is on the alternative account, the less interest you're gonna pay. The higher the balance is in the alternative account, the more interest you're going to pay. Okay? So in situation like that, you know, all your smaller expenses could go before, you know, all your larger expenses could go at the end of the month. Okay? It's because if smaller expenses go out first, so more income stays in the account. So that means the balance is gonna stay lower for longer. You're gonna pay less interest. But if you allow larger expenses to go out first, which means, because you know expense is gonna increase the balance, so now your balance is gonna be larger, so you're gonna pay more interest because you have a larger balance. Because remember, those things are being computed average daily, most of them. Okay, average daily. Especially in the case of credit card is mostly average daily, mostly average daily. So you want to keep the average low. That way your interest that you are being charged gonna be low. Okay? And finally, when you change the due date, some things you have to be aware of. It might take a few cycles for any of those. Depends on the creditor. It might take one cycle for the actual due date to change. Say for example, you change, we're in February, we're in January, you change it for February. The change on the due date may not take effect until March for some creditors, so that's one cycle. Until April for other creditors, that's two cycles. And until May for some other creditors, that's three cycles. Okay, 1, 2, 3. Okay, so be mindful of that. Okay, and for some other lenders, you change it on the same month. It takes effect. The due date change. The change on the due date takes effect right away. Okay, or at least for whatever due date that you put it for. So you put it for February. Say you put something for February 28. It's good for February 28. And again, for some lenders. For other lenders, it's going to take at least one cycle. So it's going to be in March. Okay. For other lenders, 2 cycles. That's April. For other lenders, 3 cycles. That's May. Okay. So which means during the time, even though you change it, remember, it hasn't taken into effect yet. That means you're still responsible to make the payment on your old due date because the new change has not taken into effect yet. Okay, so don't be late thinking that, okay, I've made the change, I'm good to go. No, you're not good to go yet. Okay, Because remember, for some lenders, it takes a few cycles for the change to take into effect. Okay, so make sure you're not late by staying on top of it and pay the older cycle, the older due date that you pay the bill on the older due date that you had. Okay, because nothing is in full force yet. Okay, now, like I mentioned earlier, for some lenders, you see all the different issues that you might come across, all different roadblocks. Okay, they do not want you to change the due date to a date that you want. Okay, you owe them the money. They don't care. They're gonna give you the due date that they want to give you. In the case of some of these lenders and some of the credit cards, and again, not all of them do that. Okay, but some of them do that kind of stuff. Okay, so just in case you did not know that these folks actually declare war against you in your fight against debt, just in case you didn't know, okay, can't even get the due date that you want. Okay, so you have to look at this paying up debt thing as a fight, as a true fight, because don't forget, America, this is where we are. 64% of us are living paycheck to paycheck. Okay, and 68% of us cannot come up with a $400 emergency. Okay, so we're trying to change the due date to allow us time if we're going to use alternative account. Okay, so the income, we have an opportunity to come in first, because remember from prior lesson, we want our income to come in first, and we want our income to be greater than or equal to expenses. And these are some of the issues that we'll come across. Okay, all right, America, I'll give you about 5-10 seconds to take a look at what's on the board. Then I'm going to start erasing stuff from the board. All right, America. All right. Now we're going to start working on the second question that was posed. And that second question posed to me, which was, can you run your method against the other method? So against Debt Snowball, against Debt Avalanche, against Velocity Bank. All right. Now, America, from prior lessons, we cover a terminology that I called Ambroise's partitioning a balance. Okay? Ambroise's partitioning a balance. And again, for those of you who missed that lesson, Ambroise's partitioning a balance. That is, when you're looking at the balances and you're stuck, you do not know which one to pay off first. You have to employ Ambroise's partitioning a balance. And again, Ambroise's partitioning a balance is to divide the balance into at least two separate parts, where one of the parts will equal the other account that we're trying to compare it with. So in the case of Debt Snowball, so Debt Snowball is first on the list, so let's start with Debt Snowball. And again, this is for comparison purpose only, okay? Comparison purposes only. So, looking at the balance, you know Debt Snowball wants to attack, this group wants to attack the lowest balance first. So on the board, we have 8,000, 5,000, 50,000 for balances, and 3,800. So in a case like this, the lowest balance is 3,800. So Debt Snowball group would want to attack the lowest balance, which is 3,800. Okay? Now, we're going to kind of go over some of the issues when you are trying to pay the lowest balance. Okay? Look at the APR on that lowest balance. It's only 2.99. Okay. Look at the highest APR that we have on the board. We have Chase, 26.50. Okay. Now, let's see how much that is. So 26.50 minus 2.99. So we have a difference of 23.51%. Okay, that's on the APR side. Okay, America. So every time I decide to make a payment to the PenFed personal loan, which is the lowest balance account, the account with the lowest balance, okay, I am forced to pay 23.51% extra on another account, which is Chase. Okay? So as you could see, sometimes when you decide to pay the lower balance, you're kind of going backwards. Okay? So for every time you make the payment towards the 3,800, you're in essence saving the 2.99. So you're saving at one place 2.99, but you're being charged somewhere else to 650, which is a difference of 23.51%. See, in a scenario like this, you are losing, you are going backwards, okay? Now, let's take a look at the payment rate charge. Remember, the payment rate charge in the case of a lender, a creditor charging you a flat fee for monthly payment. So the payment rate charge governs how much money you earn back every time you make a payment to one of these accounts. And again, we're assuming this is a flat fee, okay? So if you decide to go with Debt Snowball Group by attacking the lowest balance, which means for every dollar of payment that you've made, you're only earning back, let's see, 1, 2, 3, 4, 1, 2, 3, 4. You're only earning back 3.48. That's how much you earn back for every dollar of payment that you made towards the PenFed personal loan, okay? Because remember, they're charging you 3.48. Every payment, that's how you earn back. You earn back what they're charging you, okay? In the case of a flat fee, okay? But on the board, America, we have Chase 3.78. Okay? And again, real quick, let's see how much that is in 3.78 minus 3.48. Okay? So we at, okay, 0.30%. That's how much you're losing. So, and this is on the payment rates charge side. And this one will pretty much let us know that at the end of it all, how much cash flow that we earn back. Okay? So after we're done paying $3,800, all we're gonna earn back is $132.09. Okay? In additional cash flow. Okay? So let's run it. 3,800 times how much you earned, 3.48%, okay, which is that. And sure enough, it should be the 132.09, but let's run it just for good measure. 3,800 times 3.48 that you earn back. $132.24. It's supposed to be 24. So 132.24. Okay? That's how much you earn back. Okay? Now, if you make the same 3,800 payment towards the account with the larger APR, okay? And this one was PenFed personal loan. PenFed. Okay? And because remember, the Chase is a credit card. So for revolving accounts, for revolving credit accounts, you don't have to necessarily pay off the account completely in order to achieve the so-called snowball effect. So if you pay $3,000, if you just made a partial payment, you don't have to pay it off. You just made a partial payment to the Chase for $3,800. Okay? And how much you earn back in the Chase? In the Chase, you earn 3.78. Okay? And this one was PenFed, and this one will be Chase. Okay? So 3,800 times 3.78%. So 143.64. Okay? So if you go with Debt Snowball, you're gonna have an additional 132.24 in cash flow that will go towards the next lowest debt. But if you pay the Chase instead, you're going to have a larger cash flow gains, 143.64. That will go towards the next lowest debt if you are doing Debt Snowball. As you could see, America, on the APR side, like I mentioned from a prior lesson, you register a loss. On the payment rate charge, you also register a loss. Okay? So 2 losses. Here, for attacking the lowest balance, okay, you accepting the fact that you're being charged 23.51% more, which doesn't make no sense in that particular scenario. And over here on the payment rate charge, you decide to earn %0.30% less, okay, in terms of how much cash flow you get back, Okay? So talking about snowball effect, okay? You would want the larger, bigger snowball effect, 143.64, and not the smallest snowball effect, 132.24. You do not want the baby snowball effect, 132.24. Okay? You will want to go for the larger snowball effect for paying the chase instead of the pen fed, 143.64. Okay? So these are some of the issues that you might come across when you try to pay the lowest balance first. Okay? Depends on the scenario. You might be losing at two separate places. The primary, the standard, that's the APR, you're losing 23.51. And other places that don't really matter as much, that's the payment rate charge, 0.30. Okay? So, and again, when you're paying off debt, America, I keep telling you guys, do not practice any form of favoritism. Do not practice any form of fanaticism when you're paying off debt, because you're going to end up hurting yourself in the process. In this case, attacking the lowest balance, okay, when you're going backwards by allowing yourself to be charged, whether directly or indirectly, 23.51% more. You don't want to accept being charged 23.51% more. Okay? And then the payment rate charge, which governs how much cash flow you get back, you're losing 0.30%. So you're losing at two places. Okay? So it depends on the scenario. It's really not a quick win. It's really a quick loss. Depends on the scenario. Okay? And as far as momentum, you're getting the worst momentum ever because you're going backwards. You're saving 2.99 while you're losing 26.50. Okay? That's not a good momentum on the snowball effect. Because over here, for paying pen fed, you're only earning back 132 after everything's said and done. And if you pay the same 3,800 into the chase, instead, you're earning back 143.64, which is a larger amount to go towards the next lowest debt. Okay? And again, the so-called snowball effect is achieved whether you pay one account off completely, so whether you pay the pen-fed personal loan completely, or whether you pay another account partially, even if you made a partial payment of $3,800 towards that account, you're still gonna achieve the same snowball effect because the Chase one is a revolving credit account. You don't have to pay it off completely to get back cash flow, okay? Because as you pay down the account, what happened to the monthly payment charge? The monthly payment gets lowered, okay? Which means cash flow will get increased, okay? So you pay it down, monthly payment will be lower, and cash flow will go up, okay? You don't have to pay it off. It's a revolving credit account. You do not have to pay it off completely. You could just make partial payment and still achieve the so-called snowball effect. Okay, America? So, these folks, the Debt Snowball group, they did not properly analyze the so-called snowball effect. Okay? Indirectly, they did not properly analyze it because they're not really concerned too much about those things, it seems, because remember, their main objective is to attack the lowest balance. Okay? Everything else is kind of secondary. Okay? So by attacking the lowest balance, which force them not to properly analyze the so-called snowball effect, because 143 here would have been better than 132 there. Okay? So 143.64 is larger. Okay? All right? So for that reason, you have to have, America, you have to have situational awareness to know when it is beneficial for you, okay, to attack the lower balance. Okay? If I'm losing 23.51 and I'm also losing 0.30 on the cash flow gain side, I'm losing at two different places, then in a situation like this, I should not be attacking the lowest balance because I'm losing at two different places. Okay? So situational awareness. Okay? Know what you have, know when to apply these guys, know when not to apply these, not to go for that method. Okay? Because remember, okay, your goal is to pay off debt. Your goal is not to go backwards. Okay? Because this one's gonna drag you. That's a drag right here. Saving 2.99 when you're being charged 26.50 somewhere else, a difference of 23.51. That's a drag. So similar to like taking, one step forward and then two steps back. Okay? So that's what you're doing. All right? So be careful. All right? And remember, there shouldn't be any need for you to be attacking the lowest balance, lowest balance, lowest balance. These are all your debt. At some point, you have to face your own debt. You cannot psychologically I have to attack the little one first. No, these are all your debt, America. Your own debt. You have to face it sooner or later. Okay? But you can go about it in a way that's going to hurt you. Okay? In this particular example. Now, there might be some other example where it's good to pay the lower balance, but majority of the time, it's not good to pay the lower balance. Okay? Don't be afraid of it. It's your own debt. You got to attack it whether today, tomorrow, the day after. You still got to get rid of your own debt. So, nibbling at the debt by attacking the lowest balance, that's not the best approach. Okay? Especially in a situation like this where you register two losses. Okay? On the APR side and on the payment rate charge side, which governs how much cash flow you get back in the case of a flat rate. Okay? All right. Now, on our observation session, let's find out how Debt Snowball would do. Okay. On the cash flow side, we have 3.48. You know what, America? Let me give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Okay. Now, earlier, I mentioned to you that when you're having a hard time figure out which debt to pay, you have to employ Ambroise's partitioning a balance. And Ambroise's partitioning a balance is to divide the balance into at least two separate parts, where one of the parts will equal the other account you're trying to compare it with. So if we were comparing Chase with the PenFed personal loan, so the PenFed personal loan would be $3,800 at 2.99%. Okay? Now, let's compare it let's try to have an apples to apples comparison with the Chase. So the Chase one would have been, remember Chase is 8,000 at 26.50%. Let's break this down over the course of 1 month. Which would have been the same as 8,000. And again, we're just trying to partition the balance. 42. Okay, at 26.50%. At 26.50%. Okay. That's how you, okay? That's how you break it down. Again, Ambroise's partitioning a balance is to divide the balance. The balance is 8,000. To divide it into at least 2 separate parts. 1, 2, where one of the parts, 3,800, will equal the other account we're trying to compare it with. 3,800 here, 3,800 there. That's how we have an apples to apples comparison. Okay? Now, America, it's easy to see now when the balances are the same. If we have 3,800 at 2.99%, and we also have another 3,800 somewhere else. This one is Chase, and this one is PenFed. Okay, at 26.50%. So you would much rather pay that 3,800 at 26.50% instead of 3,800 at 2.99%. Okay. Because if we're trying to break it down per month, just to prove to you that it is the same, 8,000 times 26.50% divided by 12. Okay, the interest portion will be about the same. Okay, let's do 4,200 times 26.50% divided by 12. 92.75. And let's do 3,800 times 26.50% divided by 12. 83.92. Okay? As you can see, when you add these two up, we should arrive at 176.67. Let's do it. 92.75 plus 83.92. Sure enough, 176.67. Okay? And again, whenever you try to compare two accounts, you're not sure what to do, you bring them to an apples to apples comparison by breaking it down by employing Ambroise's partitioning a balance, which is to divide that balance into 2 separate parts. 1, 2, where one of the parts will equal the other account we're trying to compare it with. So we're trying to compare Chase with PenFed personal loan. So in order to have an apple to apples comparison, we bring them back. We bring them down to the same balance. 3,800 here, 3,800 there. Okay? All right. So that's how you do it. So you'll be almost as if you have an additional account. Okay? Almost like you have PenFed, 3,800 at 2.99%. And then you have Chase, because remember we're breaking the Chase down into 2 separate parts, almost as if you have Chase, 3,800 at 26.50, okay, and Chase at 4,200 at 26.50, okay. Same thing, whether you have an additional account or not, okay, you still owe the same amount. It's still 8,000 plus 3,800 or 11,800. Okay. Same thing here, 38 plus 38 plus 4,200, same thing, 11,800. Okay? The balance hasn't changed whether you choose to pay 3,800 into the PenFed or whether you choose to pay 3,800 into the Chase. You still owe the same balance. The balance hasn't changed. Okay? We're just breaking it down for you, okay, to show you that if we have 3,800 at 2.99% and we have 3,800 from another account at 26.50%, we will of course pay the 38 with the higher APR. Okay? All right, America, I'll give you about 5 seconds to take a look at this real quick, and then I'm going to start erasing that from the board. All right, America. Okay. So the results, Debt Snowball will tag the lowest balance, 3,800, and they'll send cash flow towards it. So cash flow will be 314. And the account would be PenFed personal loan. Okay? Now, let's find out real quick what's the simple average on the PenFed. Okay? So the simple average, that's when you add all these averages divided by the number, or these APR divided by the number of APR. Okay? So 2650 plus 2100, 21%, I'm sorry, plus 10% plus 2.99. Okay? We got 1 item, 2 item, 3 item, 4 item divided by 4 items. So the average would be the simple average on the APR, $15.04. Okay? That was for Debt Snowball. Now, let's move over to Debt Avalanche. Debt Avalanche wants to attack the highest APR. The highest APR on the board, 26, 21, 10, is Chase. So, and Debt Avalanche will send cash flow towards the highest APR. So cash flow is 314. So cash flow, 314. The account would be Chase, because Chase has the highest APR. And the simple average, same thing, okay, will be these four, 2650, 2110, and 225 divided by 4. Okay, so the simple average APR would be 15.04 as well. Okay, 15.04%. All right. Now, for velocity banking, these folks, Debt Snowball, Debt Avalanche only uses cash flow. But velocity banking, these folks, they chunk. And they also use a debt weapon. In addition to cash flow. Okay? So let's run velocity banking real quick to figure out what are the numbers for velocity banking. Okay? Now, the folks over at velocity banking sometimes uses 2 separate formulas. One is cash flow. Okay? The other formula they might use, since there's a region preferred personal line of credit on the board, they might take a look at the region's preferred personal line of credit. And for availability, we have 10,000 here. Cash flow here is only 314. So even if they multiply cash flow by a certain formula, cash flow is still going to be too small not comparable compared to what we have on the board with the region preferred personal line of credit, 10,000 available. So in a situation like that, because cash flow is too small, not comparable, they'll move over to the region's preferred personal line of credit. Okay? And some of the folks, from my research session, I've noticed that they only want to go up 80% on the ELOC. So let's run the numbers real quick to figure out how much that is, okay? And how much they will have available to go towards paying off debt, okay? So, velocity banking, if they use the regions, $25,000. So 80% of that, because remember, my competitor, Velocity Banking, most of these guys, this group only want to go 80% of the credit limit. So 25 times 80%. So we have 20,000. Okay, that's for the regions personal line of credit. And again, it's a 2-3 personal line, and we are on year 1 of 2. Okay, so which means we are in a drop period. Okay, so 20,000 max that they could go, but they already owe 15,000. So 20 minus the 15 existing balance. So now they are left with $5,000 to use towards paying off debt. Okay. Now with that $5,000, these folks, this group sometimes follow Debt Snowball. So on the board we have 8,000, 5,000, 15,000, and 3,800. But then likely with 5,000, they either might pay the personal, the PenFed personal loan, or they might pay the Wells Fargo. But looking at the monthly payments charged, okay, the personal loan is only 132, but the monthly payments charge is 190. So in a scenario like this, they will get a larger cash flow gains for paying the Wells Fargo instead of the personal loan, instead of a full payment to the personal loan and a partial payment somewhere else. So in this case, they're gonna attack the Wells Fargo, okay? So if they're gonna attack the Wells Fargo, Chase gonna stay the same, okay? 8,400. The APR for Chase will stay the same, 2650. The balance for Chase will stay the same, 8,000. Monthly payment 302.40. 400. 95.24. 3.78%. Okay. Now, Wells Fargo, we did say they're going to attack Wells Fargo. So now Wells Fargo will be affected. The limit, 5,300. The APR, 21%. The balance, now with that 5,000, they're going to get rid of this Wells Fargo balance of 5,000. So that balance is going to become 0. Okay, the monthly payments charge, since the balance is 0, America, the monthly payments charge will be 0. The availability, we know availability is credit limit minus balance owed, so 5,300 minus 0 is 5,300. And the credit utilization is balance owed divided by credit limit, so 0 divided by 5,300, so we had 0. And the payment rate charge is monthly payment charge divided by balance owed. So 0 divided by 0, we had 0. Okay. Next account is the region's preferred personal line of credit. Okay. limit 25,000. The APR 10%. Now the balance, you went from 15,000. Remember, they use up the max, which is 20,000. They use 15,000 plus they use the additional 5,000 to get rid of the Wells Fargo. So now the balance is going to get increased by 5,000. So 15 plus 5,000. So we are 20,000. Okay. The monthly payments charge. Monthly payments charge is 3%. Remember, this region preferred is principal and interest, and it's going to be $50 or 3% of the balance owed, whichever is greater. So 20,000. Remember earlier we mentioned that this region personal line of credit is not interest only. That one is principal and interest. Okay? And regions wants you to pay $50 or 3% of the balance owed as a monthly payment charge, whichever is greater, whether it's 50 or the 3%, whichever is greater. So 20,000 times 3%, so we had 600. Okay, so 600 is greater than $50, so we're gonna go for the monthly payment of 600. Okay. Availability is credit limit minus balance owed. So 25,000 minus 20,000, that's 5,000 available. Okay. And credit utilization is balance owed divided by credit limit. So 20,000 divided by 25,000 America. So we had 80%, because remember, they only want to go 80%. Talk about my competitor, Velocity Banking. And the payment rate charge, we know it's 3%, but let's run it just for good measure. Payment rate charge is monthly payment charge divided by balance owed. So 6,000 should be the 3%. 600 divided by 20,000. So we had 3%. Okay. All right. So these were the two accounts that get affected. So we did not touch the PenFed personal loan. So PenFed personal loan. Okay. So 10,000 right here. 2.99, 3,800, 132.24, and again we did not touch PenFed. And availability, since it's a revolving credit account, that does not apply. Credit utilization, those things are mainly for revolving credit accounts, and PenFed personal loan is an installment credit account. Okay, and the payment rate charged is 3.48. We did not touch it. Okay. All right. So now let's figure out real quick what was the cash flow for Velocity Banking. And again, these two were the two accounts that get affected. So for cash flow, we have, initially we're at 190 plus 450. We had 640 minus, so Wells Fargo got affected and region got affected. So 190 plus 450, okay, equals 640 minus the Wells Fargo, which is 0, minus the 600. Okay, so these folks get an additional $40 in cash flow. Again, we're only dealing with the account that get affected. Okay, this 302.40 stays 302.40, 132.24 stay 132.24. The only two accounts that got affected in America was the Wells Fargo and was the region preferred personal line of credit. So to see how much cash flow additional, we add these two minus the new amount. Okay, So 190 plus 450 is 640 minus 0 minus 600. So that's how we arrive at 40 bucks. So Velocity Banking will get an additional $40 in cash flow. Cash flow originally was 314 plus the 40 bucks. So 314 plus 40 bucks. So Velocity cash flow for Velocity Banking got increased to 354. 354. Okay? Now, remember my competitor Velocity Banking practices what I refer to as favoritism. So whichever account that they use to chunk, in this case, that was the region preferred credit card. So it's going to be regions preferred personal line of credit. Is the same account that they're going to use as a debt weapon, so it's still going to be regions. Preferred personal line of credit. And it's also the same account that's going to keep the cash flow. So the 344 at a later time going to go to the region. Okay. Preferred PLOC, personal line of credit. And again, internally I refer to that aspects of it as favoritism, because they use the same account to chunk, the same account as debt weapon, the same account as cash flow. Okay? Okay? And real quick, let's find out what the sample average on the APR. Okay? Now, these guys, they got rid of the Wells Fargo, so all they have left on the APR is 2650, 10, and 2.99. So 2650 plus 10 plus 2.99. And how many items do they have left? They have one item left, two items left, three items left. Wells Fargo is gone, at least on paper, because Wells Fargo is zero balance. Okay, so 3949 divided by 3. So we had 13 for sample average APR. We had 16%. And as you could see, Velocity Banking in this particular example is doing better than Debt Snowball. Debt Snowball average is higher. Debt Avalanche average is higher. Velocity Banking average is lower. Okay? And again, that average, that's how much you're being charged on average on the debt. The debt is $31,800. So you would want to be charged a lower APR on the debt instead of a higher APR on the debt. So Velocity Banking in this particular example is doing better than Debt Snowball, is doing better than Debt Avalanche. Okay? Alright, because they have a better average. And again, the average is the cost. That's the interest rate. That's the cost of borrowing on the entire debt, which is $31,800 when you add all these debts, all these balances. Okay? Alright. Alright, America, I'll give you about 5-10 seconds to take a look at what's on the board, and I'm going to start erasing stuff from the board. Alright, America. Now, the next one is Ambroise Method 1.0. So far we've run Debt Snowball, a quick result for Debt Snowball, quick result for Debt Avalanche, quick result for Velocity Banking. Now we're going to do Ambroise Method 1.0. Alright, America, if you could remember from prior lessons, we says that Ambroise Method 1.0 calls for a series of steps, and some of the steps have to be taken at least once a month. And what were the steps, James? Steps was segregate, compare, transfer, repeat, okay? And now there might be some conditions, some exceptions, some restrictions to the strategy. And we're going to cover condition, exception, restrictions on another lesson, okay? And these items were above the line. And then we have some items below the line, which is can we use cash flow or can we use a large payment? And then we have the what after that, WHT. Okay? Now, to segregate, to save time, I've already, again, we're running Ambroise Method 1.0 now. To save time, I've already segregate the list of debt. Remember, we like to segregate by account type. We like to, we have credit card, personal line of credit. That personal line of credit, we are in a draw period, so it's considered revolving. When the personal line of credit is not in a draw period any longer, then it is not a revolving account, okay? Because remember, we're still on year 1 of 2, so we're still doing a draw period, which means we could use and reuse this region preferred personal line of credit. So it's still in a draw period, so it is revolving. When we're in the repayment period, okay, after the 2 years expire, on the 3rd year, on the 4th year, on the 5th year, we're in a repayment period, then we cannot use it and reuse it any longer. So it's not going to be revolving because we cannot use it and reuse it. It's going to be installment, okay, in the installment category, okay? So again, to save times, I've already segregated. So we have Chase credit card, that's revolving. Wells Fargo credit card, that's revolving credit account. Region preferred personal line of credit, that's revolving credit account. Then we have the PenFed personal loan, that's installment credit account. So, and I prefer the revolving on top, the installment at the bottom. The personal loan is an installment, it's at the bottom, okay? So segregate's already done. The next we compare. And how do we compare? We compare by APR, okay? And again, to save time, I already rearranged the list. If the list was in no kind of order, then you have to rearrange it further. I've already rearranged it by APR to save time. I prefer the higher APR on top and the lower APR at the bottom. So 26, 21, 10, 2.99. So comparing by APR is already done for us. Okay? So now, next we're going to transfer. Okay? Now, how do we transfer? We transfer from the absolute highest APR to the absolute lowest APR. So, in other words, we'll relocate from the balances from the 2650 into the 2.99. Okay? But the 2.99 is a personal loan. Okay? We cannot add to the personal loan. 3,800, we cannot add anything to it because it's a personal loan. So in this case, we cannot relocate from here to here. So now we have to move to the next highest, from the highest one to the next lowest one. Okay? So in this case, we have to relocate balances from the 2650 to the 10%. Okay, because remember the loan is a no-go. Okay, it's a no-go. All right, because it's a loan. Okay, in this particular example. All right, so 2650, we're gonna try to relocate the balance from the chase to the regions. Okay, so now when we look at the regions, we see that regions have availability of $10,000. So there's room in the regions. Okay, so now we're gonna make a transfer, but first let's figure out how much of the $10,000 are we able to use. Okay, and for our method, remember we're very aggressive. Sometimes we go as high as 99%, but in this particular example we're gonna go 94%. Okay, so region, let's figure out how much that's gonna be. It's 25,000. Remember, we're very aggressive. Ambroise Method 1.0 is a very aggressive method. Okay? We don't like to babysit higher APR balances, account that has higher APR. So we're always trying to relocate them to a better, lower APR environment. So 2650, we're trying to relocate it to a 10% environment. Okay? So we're going to move some of the balances from the 8,000 to here. Okay? And again, for being super aggressive, we're going as high as 94%. We're going to go 80% like our competitor Debt Snowball is doing. We go as high as 99%. But in this particular example, we're going to go 94%. And again, maybe at a later time, I'll do a lesson on how I determine that percentage, okay? But we're not going to cover that today. In another lesson, I'll probably cover that, okay? So, 25,000 times 94% is 23,500 on the regions. But we already owe on the region 15,000, so minus 15,000 to see how much we have, how much we could use. So now we have 8,500 that we could use towards paying off debt. Okay. Now with that 8,500, because remember we could go as high as 23,500 to pay off debt on the regions, but regions already have a balance of 15,000. So really all we have left is the 23,500 minus the 15, which is 8,500. Okay. When we look at the list, we see there's a chase with a higher APR 2650. So we're gonna of course try to attack the chase. But chase is only 8,000. Over here we have 8,500. So we're still gonna have 500 left to attack more debt. In this case, we take a look, we see that the Wells Fargo also is the next highest APR. So we're gonna send the 500 to the Wells Fargo one. Okay? So we're gonna attack two accounts. Chase for 8,000 and 500 left, 500 towards Wells Fargo. Okay? Alright, so now let's start running Ambroise Method 1.0. So Chase, the credit limit stayed the same, 8,400. The APR, 2650. The balance now, remember we have 8,500 to use towards paying off debt. We're going to get rid of this balance. So the balance is going to become 0. Monthly payment charge balance is 0. Monthly payment charge is going to be 0. The availability is credit limit minus balance owed. So 8,400 minus 0, so we are 8,400. Credit utilization is balance owed divided by credit limit, 0 divided by 8,400, so we are 0. Payment rate charge is monthly payment charge divided by balance owed, 0 divided by 0, we are 0. Okay. All right. Next, we have Wells Fargo. Wells Fargo credit card, limit stays the same, 5,300. The APR, 21%. The balance owed. Now, remember, we're at 8,500. Use 8,000 to knock out, to get rid of the chase, so we still have 500 left. So 5,000 minus the 500 left, so we should be at 4,500. Okay? And the monthly minimum payment is 380 of the balance. So if we have 4,500 times 380 to see what the new monthly payment is going to be, 3.80%. So we have 171. Okay. Availability America is credit limit minus balance owed. So 5,300 minus 4,500. So we have $800. Okay. Credit utilization is balance owed divided by credit limit. So 4,500 divided by 5,300. So we are at 84.91. Okay, and payment rate charge. Payment rate charge is monthly payment charge divided by balance owed. So we should get at the 380, but let's run it just for good measure. 171 divided by 4,500. Okay. So we had the 380% that we know it would be. Okay. So far we've attacked two accounts. With 8,500, we knock out Chase and we reduce the Wells Fargo by $500 that was left over. Okay. Now, next account is Regions. Regions personal line of credit, 25,000. APR 10%. Now the balance got increased because remember we went all the way to the max, 15,000, and again 15,000 plus the 800 that we used to knock out this Chase, plus 500 towards Wells Fargo. Okay, so we should be at the max 23,500, and again that was 1,500 plus 8,000 plus 500. Okay, and the monthly payments charge, remember it has to be $50 or 3%, because on the Region personal line of credit it's not just interest only, it's principal and interest, and they want at least 3%, 50 or 3%, whichever is greater. Okay, so 23,500 times 3%, so we at 705. Okay, 23,500 times 3%. 705 is greater than $50, so we're going to use 705 instead. Because remember, for principal and interest, they want $50 again, or 3%, whichever is greater. Okay, so availability is credit limit minus balance owed, so 25,000 minus 23,500. We had 1,500 for availability. Okay. And credit utilization is balance owed divided by 25, should be the 94%, but let's run it just for good measure. Divided by 25, sure enough, 94%. And the payment rate charge, again, we did say it was 3%, but again, let's run it just for good measure. 705. Payment rate charge is monthly payment charge divided by balance owed, so 705 divided by 23,500. Okay, sure enough, 3%. Okay, so we charge these three, and PenFed personal loan, we did not touch PenFed personal loan. So PenFed will stay the same, 10,000, 2.99%. $3,800, 132.24, and because it's an installment loan, the availability doesn't matter, the credit utilization doesn't matter for installment credit account. And 3.48%. Okay. All right. So that was transfer. Okay. Now, is there opportunity for us to repeat the transfer? Because remember, we're still above the line. And for our tag, we have the T here, the A here, and the C there. Okay? Is there still opportunity to do more transfer? Okay? So far we know that the personal loan is a no-go. The region PLOB, we just use the region PLOB. So now all we're left with is just the Wells Fargo, because Chase is already gone. We've already zeroed out that account. Okay. So now there's no more opportunity to do transfer. So in that case, we're gonna go downstairs. Remember, that was above the item that was above the line. There goes the line. Okay. So now we're going to start working on the items that are below the line. There goes the line. Okay. Okay, below the line, we have, can we use cash flow or a large payment? Okay. We did not get any bonus check during this period. We did not receive any income tax refund during this period. We did not receive any other type of funds, additional funds, so we cannot use any large payments. So in this case, it's going to be cash flow. But let's figure out real quick how much our cash flow is. Remember, for our example, the three accounts that get affected was the Chase, because we use $8,500 to knock out the Chase, and we also pay the Wells Fargo, and the region preferred personal loan got affected. So we dealt with these three accounts. So for cash flow, initially we were at 302.40, so 302.40 plus 190 plus 450. We had 942.40, and the three account that's where we were originally, and this is where we are now. We are here, we are here, we are here. So 942.40 minus the 171 minus the 705 minus 171 minus 705. So we had 66.44 in additional cash flow. 66.40. Okay. So this one got affected, that one got affected, that one got affected. Okay. Again, let me run my number one more time, making sure I did not make any mistake. 32.40 plus 190 plus 450 minus 0 minus 171 minus 705. Perfect. 66.40 in additional cash flow. So now for Ambroise Method 1.0, cash flow will be the 314 plus the additional cash flow 66.40. So 314 plus 66.40 is 380.40. Okay. All right. And so that was cash flow. Now let's enter the what. Which account to use how much of a payment and to pay down which debt. Remember, we're downstairs now. So now we're done with transfer. So now we're going to be dealing with the alternative account and we're going to be dealing with cash flow. But we have to answer the what. So now we know we're going to use cash flow because we did not receive any large payment. So now the what, which account to use for an advanced user, okay, that is using an alternative account, okay? So on the board, we have the chase is gone. Okay. But real quick, let me give you guys 5-10 seconds to take a look at what's on the board before we continue with the exercise. All right, America. Now, on our side, let's figure out what's the average gonna be, the sample average on the APR. Okay. So chase is gone. So now we are left with 21, 10, and 2.99. 21% plus 10% plus 2.99. And how many items we have? We have 1 item, 2 items, 3 items. So divided by 3. So now our average is, our sample average APR is 11.33%. Okay? So that is how much we are going to be charged on the debt, and the debt is, it originally was 31,800. Okay, it's a lot lower now because we got rid of a few items. Okay, but this is our average, 11.33. Okay. All right. So far, as you could see, that Snowball has a higher sample average on the APR, 1504, that Avalanche 1504, velocity banking 1316. Our average is a lot better. We are 1133. You know, with the average, the lower the average is, the better. So we are 1133. We are lower than these guys. We 11, they 13, they are 15. 13 and some change, 15 and some change. We are 11. Okay, so far we have a better average than the other 3 debt repayment method. Okay. Now, let's figure out, since we're doing Ambroise Method 1.0 for an advanced user. Remember, an advanced user from prior lessons uses the T for transfer, using the A for alternative account, uses the C for cash flow. Okay, as opposed to a normal user, because our method has 2 separate types of user. Our normal user uses the T for transfer, uses the C for cash flow, but our normal user do not use alternative account because they don't quite understand it yet. But for this example, we're using Ambroise Method 1.0 for an advanced user. So we use everything that's on the board. The T, the A, the C, that's our tag. Okay? So, in this case then, let's figure out which account is going to be our first in line alternative account, which account is going to be our next in line alternative account. Okay? On the board, we are left with Wells Fargo 21%, Region PLAC 25%. Okay? From prior lessons, and PenFed loan at 2.99%. From prior lessons, we've learned that if we have multiple alternative accounts, okay, and some of them offer greater results, some of them offer greater liquidity, let's figure out which one's going to give us the greater results in terms of reducing interest cost. Okay, so in terms of reducing interest cost, okay, when we send payment to the higher APR one, we get better results. Okay, so for that reason, our first in line alternative account gonna be the Wells Fargo credit card. Okay, so Wells Fargo will equal first in line alternative account. Okay? And Wells Fargo will offer greater results in reducing interest cost. Now remember, on our example, Wells Fargo is a credit card, and on the example, it shows that only $820 could go on a credit card. But for expenses, we're at $2,686. So in this case, we're gonna look for another account that will give us greater liquidity. So in this case, it will be Regions Preferred Personal Line of Credit. Okay? So Regions Preferred Personal Line of Credit. And this one gonna be next in line. Alternative account. Okay? And again, first in line alternative account, which is the Wells Fargo, larger APR, bigger APR, so that one's going to offer greater results in reducing interest costs because we want our payment to go to the higher APR. And Region Preferred PLOC, this one will offer us greater liquidity. So this one will be next in line alternative account for bills that cannot go, and they also accept bills that cannot go on a credit card. Okay? All right. So let's find out our numbers. So initially we say we're going to use cash flow. And let's find out which account we're going to use. In this case, we say we're going to use both the Wells Fargo and we're going to use the Regions PLOC. Okay? Okay? So now let's figure out how much, that's the what, which account, how much and to pay which debt, the what. Okay? So for Wells Fargo, we have Wells Fargo will accept the bills that could go on a credit card. So that's $820. Wells Fargo will also accept its own minimum payment, which is $171. And Wells Fargo will also accept the cash flow, because remember, cash flow is better served in the account with the higher APR. Okay? So 380.40. So tentatively, we're going to have 820 plus 171, which was the minimum payment on the Wells Fargo, plus 380.40. So altogether, Wells Fargo will receive tentatively $1,371.40. Okay? And the Region Preferred Personal Line of Credit will accept its own minimum payment, which is $705, plus whatever other debt that could not go on the credit card. Remember, with credit card, you cannot pay all debt instantly. So 705, but remember, for income, total income was 3,000. So if we have 3,000 minus the 1371.40 minus the 705, so this guy will also receive 923.60 for a grand total tentatively, 923.60 plus 705 is 1628.60. And if we add these two, 1628.60 plus the 1371.40, we should arrive at the $3,000 in income. Okay? Similar to a zero-based deal. All right? So now, how much for the Wells Fargo? They're gonna get 1371.40, and Regions 1628.60. Okay. Now, Regions prefer personal line. America is at 10%. Wells Fargo is at 21%. When we send 923.60 to the Region personal line of credit, you see, depends on the timing. When we send that amount, well, that amount is greater than the 705.50. Okay? Which means that the Wells Fargo one would have what I called absorption opportunity. Let me put that on the board. To where the Wells Fargo will get to keep some of the minimum payment from the Region personal line of credit. Okay? So how much they get to keep, it's kind of hard to tell. On paper, it looks like 705. So the Wells Fargo will get, let's say, less than 705. Okay? Because remember, in real life, when you're paying off debt, there's going to be some interest added to it. And by the way, that is one of the mistakes that my competitor, Velocity Banking, is making. Okay? They think on the absorption opportunity, what I call absorption opportunity, that the other account will get to absorb the entire monthly payment from the personal line of credit. Well, in this case, it wouldn't even be personal line of credit for them, because you remember these folks, they practice favoritism. But for other scenario, they think that the other account will absorb the entire amount. The other account will not absorb the entire amount, because you have to take into account whatever interest that is going to erode, that's going to take away from the regular monthly payment on that account. So 705 is not going to be 705. 705 is going to be less than 705. Okay? So the Wells Fargo one might get increase from 1371.40 plus a number that is smaller than 705. And again, in real life, depends when income comes in, when expenses goes out, okay? Because remember, it's a next in line, so, it's hard to tell in real life. But on paper, we know it's 705. In real life, it might be a number slightly smaller than 705, okay? If it's 680, then the Wells Fargo will get increased by 680. If it's 690, 690. If it's 650, 650. Whatever the amount, okay, after you take into account the interest, okay, that's actually being taken out from the regular monthly payment. Because remember, we're here now. Once we make that payment, we pretty much satisfy the regular monthly payment, the regular minimum payment, the regular payment on the P-lock. Okay? So we don't have to necessarily send that 705 to the region's account. We could send the 705 to the account that offers greater results. In this case, it will be the Wells Fargo. Okay? But again, Wells Fargo will also accept some of that 705. It's not going to be the entire 705 because you have to take into account whatever interest rate, okay, that was taken from the 705. Okay? All right. I hope I explained this thing clearer. Okay? And that is what I call absorption opportunity, to where the account that offer greater results will also take away from the minimum payment, because we don't want the minimum payment to reside inside this account. We want the minimum payment to be sent, at least part of it, to be sent to the account that will give us the greater results. That's how, America, you reduce your overall interest charges on those accounts. This is how you properly run alternative accounts. Okay, America? I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right. Now, let's go over the workflow. Okay. Is how the workflow going to look like? In the case of someone who has who set up automatic payment, and again, we assume when we have automatic payment, most of our bills gonna be due towards the end of the month. Okay, so the income is $3,000. Let's assume it is for somebody who is on a bi-weekly pay period, which means the 3,000. Let's assume they are equal, so 3,000 divided by 2, so it'll be 1,500 each. So the first paycheck gonna be 1,500, and the next paycheck gonna be 1,500, assuming they are equal. That's how we arrive at the 3,000 in income. These are take-home pay. Okay. Now, as soon as the $1,500 touch down your checking account, okay, for bills that can be paid with a credit card, remember we said that it was, for the Wells Fargo, $1,371. Okay? So it's going to be at least, to Wells Fargo, we're going to receive the entire $1,371. Okay? But remember now, the paycheck was $1,500. So Wells Fargo received the entire $1,371.40. So the remainder will go towards the region's personal line of credit, because this one offers greater results in reducing interest costs. The next in line account offers greater liquidity, which is the region's. So it'll be 1,500 minus 1,371.40. So region is going to receive on the first paycheck, region personal line of credit, going to receive $128.60. Okay. Now, $128.60 is not big enough to cover 705. So on the next paycheck touched down your checking account. Wells Fargo already received the entire $1,371 tentatively. That's a tentative amount. So now Wells Fargo is not gonna receive anything. So now Region's gonna get the entire 1,500. Okay? And at some point, remember now, when we were talking about our absorption opportunity, at some point, as soon as you satisfy the payment for the region, okay, minus whatever interest, okay, some of that will go back to the checking account. And from the checking account, you send an additional payment to the Wells Fargo. Okay? How much? And it has to be smaller than 705, which was the minimum payment. Okay? And again, just to explain it one more time, 3,000 take-home pay. Let's assume the two paychecks are equal, no overtime, nothing else. It's 1,500 plus 1,500. That's how we arrive at the 3,000. So on the first paycheck, for somebody who is on automatic payment, the first paycheck, remember it's 1,500, so Wells Fargo gonna get the entire 1,370, 140, and Region's gonna receive 128.60. Okay. On the next paycheck, okay, Wells Fargo did receive the entire thing, so which means some of the funds will remain inside the checking account. The remainder will go to Regions, but since we are not aware, because remember in real life it's different than when you're doing it on paper. On paper, it looks like Regions will get the entire 1,500, okay? But in real life, okay, Regions might get the 1,500, but remember, we don't want Regions to keep that minimum payment. We want Wells Fargo to absorb some of that minimum payment, okay, after interest got taken into account. So in this case, you'll be like similar to having 1,500, and part of it will go back to the checking account so you could make a payment to the Wells Fargo. And the payment to the Wells Fargo obviously gonna be a lot lower than the 705. That's our absorption opportunity. Okay? Because we want more money to go towards the Wells Fargo as opposed to keeping funds inside the Regions, because we don't want to keep too much funds inside the Regions because the region is only at 10%. Any excess, we want to send the excess, we want to transfer the excess to the higher APR account, which is the region. Okay? So remember now, the region will take care of all the bills that cannot go on a credit card. And we know those bills were, I forgot how much, but those bills were a lot lower than 1,500. So once the region receive all of that, and those bills were greater than the minimum payment on the Regions, which means the payment for the region will be satisfied then. Okay? And we don't want extra funds to remain inside the Regions. We want any extra funds that we have to be sent towards the account with the higher APR. That's the Wells Fargo one. Okay? So for that reason, Wells Fargo will absorb some of the money that are inside the Regions. And the way you do it, you send some of these funds back to the checking account. Then from the checking account, you'll make an additional payment to the Wells Fargo. And again, that additional payment will be smaller than 705. Okay? I hope I explained this thing a little bit better. And again, folks, if we're gonna use an alternative account, I keep mentioning to you guys that the alternative account is a very dangerous account. Okay? You gotta know what you're doing. Okay? Gotta know what you're doing. And another thing with our method, remember, our method, we are transfer heavy on our method. Even if you made a mistake, okay, you did not send in whatever needed to be sent in on time to the Wells Fargo. Remember, we run these things, segregate, compare, transfer, repeat, at least once a month. So it doesn't have to be one time, at least once a month. So we could do multiple transfer several times during the month. Okay? Remember, we run the steps, segregate, compare, transfer, repeat at least once a month. At least. Okay? So even if you made a mistake, you're still gonna have an opportunity to catch up. Okay? Now that's not gonna be best performance because for every day that the money was supposed to be in a higher APR account, okay? So you're gonna take a little loss there because you don't quite know what you're doing, okay? But to do it properly, okay, as soon as you satisfy the payment on the regions, gotta send the money right over to the account with the higher APR, which is the Wells Fargo one, okay? Because we want the greater results in terms of reducing interest cost. Okay, America? And again, as you watch more videos, you're gonna try to understand this alternative account a little bit better, and you're gonna have a better understanding what I meant when I talk about absorption opportunity. Okay? All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Now, let's take a look on our observation. Let me erase some stuff. Observation session. Okay. As you could see, in the case of Debt Snowball, their cash flow is 314. Our cash flow is 380.40. So we're doing better than them there. For account, they have PenFed. For account, we have Wells Fargo, and we have Regions. The personal line of credit. And as far as sample average on the APR, they had 1504. We had 1133. Remember, on the APR, the lower you're being charged, the better. So we're doing better than them on that aspect as well. Okay? And another thing with Debt Snowball, understand, America, when you're paying off debt, there will be possibly 3 assignments or 3 elements or 3 jobs that you're going to have to deal with. And these assignments are transfer. Okay? That's one. Alternative account. That's 2. And which account gets to keep the cash flow. These are the 3 assignments or 3 elements or 3 jobs that you have to deal with, you may have to deal with when you're paying off debt. Okay? For Debt Snowball, these folks, this group only uses cash flow. Okay? So they are ignoring transfers. They are ignoring alternative account. By the way, the alternative account is optional. Okay. Well, at least there's two main jobs: transfer and cash flow. One of the three is optional. Okay. So even when Debt Snowball is doing things the proper way, and remember in this particular example earlier, we proved that paying off the lower balance was the wrong way to go about it. Okay. Even when they do things the proper way, they're still gonna have a results. The best result is gonna be 1 out of 3. Because remember, we have 3 of them. And in a case where we're not using the optional one, which is the alternative account, your result's still gonna be 1 out of 2. The best results when they're doing things the proper way. So if you were scoring them, perhaps you'll say that they probably achieve 33% out of over 100. In a case where you do not want to use the alternative account because it's optional, they're still doing 1 out of 2. So that is 50% of the job out of 100. Okay? Because whether you have 2 items or 3 items, they still only use 1 of the 3 items or 1 of the 2 items. Okay? And in the case of Debt Avalanche, same thing. Debt Avalanche only uses cash flow. Okay? So Debt Avalanche will ignore transfer because this group doesn't take advantage of transfer. Okay? Does not use alternative account. Same thing. If we have 3 assignments or 3 elements or 3 jobs and they're only doing 1, so that's 1 out of 3. And again, that's 32% of the assignment. But since alternative account is optional, so let's say they're doing 1 out of 2. And again, that's still 50% of the assignment. Okay? As you could see, when you're paying off debt, America, you cannot just be using cash flow. Okay? Cash flow by itself will not go far enough in eliminating debt quickly. Okay? So that is why you have to transfer. Okay? Look at the results when we do transfer. Our sample average on the APR, okay? We're in a lot better shape because we do transfers. Okay? And we will completely blow them out of the water when we start using alternative account. Okay? So that's the importance of transferring. And that's also the importance of using alternative account after you fully understand how to properly use alternative account. Okay? All right? Now, in the case of velocity banking, they chunk 1 time. We've also did 1 transfer. Just like them, we did 1 transfer. The reason why our cash flow position is better than velocity banking is because these folks, this group was only willing to go 80%. But in our case, our cash flow is better. They are 354, we are 380 because we were willing to be more aggressive by going all the way up to 94%. They're going 80% of the credit limit. In the case of Region Preferred Personal Line, we went 94%. So now we ended up in a better cash flow position. Okay? Remember, you're really not hurting yourself on the credit utilization side, because remember, all you're doing is moving money. Okay? You move it from here. So this got bigger. It was 15, it became 23,500, just so you could pay something. You're just transferring. That's all you're doing, just relocating, reshuffle the deck. So you're not doing anything extra or anything crazy for going a higher APR. Okay? So there shouldn't be no impact to credit score at all for going for a higher APR. But the only time you might have an impact to credit score would be maybe timing. Okay? Timing, that's all. One account gets reported before another account, so the timing might hurt you. Okay? To where if you go higher on the percentage side, to where you might be hurt. Only a timing issue. Okay? Let's say this amount get reported first before this other amount gets reported. So because this amount gets reported first, okay, so that might affect you a little bit. Okay? Only timing might be a problem. But it shouldn't be any problem, because all you're doing, you move balances from one account to another account. That's all you're doing. So the credit score itself shouldn't be affected at all. But like I said, though, the timing might be a problem. If one gets reported and there's a lag between the other one gets reported. Because remember now, different credit bureaus, different lenders doesn't report at the same times. And not only that, on your credit report, some lenders might have certain items and other lenders might have different items. Okay? So, because remember, these guys, they do whatever they want. Those big banks, those big creditors. Okay? There's no uniformity as to how they are reporting stuff to the credit bureau. You got some lenders, they probably use TransUnion for a particular account. You have other lenders, they don't use TransUnion, they probably use maybe Equifax or something. Okay? So, because our government allow them to do whatever they want. So, in a sense, not completely, but in a sense, okay, so that's why there might be some discrepancies, okay, when it comes to this credit score thing or credit report, okay, aspects, okay. But other than that, like I mentioned earlier, all you're doing is you're just relocating balances. The total balance is still the same. You just move them from one place to another, okay. It shouldn't affect the credit score, okay. And we know that these folks practices what I refer to as favoritism. The region's preferred PLOC to chunk the region's preferred PLOC as a debt weapon, and the region preferred PLOC to keep the cash flow, which is wrong. Because remember, these three assignments, these three elements, these three jobs, okay, which is transfer, alternative account, and cash flow, okay, these three, you have to use the account or accounts that are best suited for the job, okay. The region preferred was good for chunking because it's at a lower APR, so you're relocating items from a higher, the balances from a higher APR into a lower APR, so that was beautiful. But as a debt weapon, to receive cash flow, to receive income, no. The region preferred was not good to receive income, at least not as a first in line alternative account, because they were at 10%. You don't want to keep sending payment to a 10% when you have a 21% account on the board. So the region preferred PLOC was not good to be utilized as a debt weapon. at least not as a first in line alternative account. Those were for bills that can be paid with a credit card. Okay? And for cash flow, you do not want to send 354 to a 10% environment. In essence, you're only saving 10% plus whatever extra for doing velocity banking on it is giving you, but the difference in APR is too large to overcome. So you cannot keep cash flow at a 10% in a 10% APR environment when you have a 21% APR environment on the board. Okay? So that's why the region PLOC was not good to keep the cash flow. The cash flow is better served in the account with the higher APR, which is Wells Fargo. Okay? So that was the observation session. Okay? Now, just to be transparent, the simple average APR, on our example, we're doing better than them. But there might be some scenario whereby they might get a head start, okay, on the simple average APR. Because remember, they're jumping into things right away. And for us, we're trying to rearrange, reorganize, okay, doing things first. For that reason, there are some scenarios where they might do better than us temporarily on the cash flow, on the simple average APR, and possibly on the cash flow, because we're not always ahead of them. Okay? Because I have to be transparent now. We're not always ahead of them when it comes to these two items, the cash flow or the simple average APR. Okay? But don't worry, whatever advantage they have over us, we refer to it as premature celebration. We refer to it as premature celebration. If ever, okay, I create an example whereby, okay, they are ahead of us on the cash flow side, or they are ahead of us on the simple average APR side. Okay? It's just premature celebration. Because remember, with our method, we don't have no drag on our method. Okay? We don't have interest that's dragging us back. Okay? Because we're always attacking the highest APR, the highest APR, the highest APR. These guys, they don't always attack the highest APR. Any of the three, these three groups, they don't always attack the highest APR. So they're going to create a drag. Okay? So for that reason, they could have a head start for a short period of time, but eventually we're going to catch up to them. Not only that, we're going to warp speed past them. Okay? That's the advantage of always attacking the biggest drag, which is the APR. Okay? So then again, they might be celebrating prematurely, and that's okay in some scenario. In this scenario, they did not. Okay? But I could create an example where I show that they will, celebrate prematurely, and then we're gonna go ahead and pass them. Because remember, we have a holistic approach when it comes to paying off debt. Okay? We're not looking just to, the lowest balance or this account or that account. No. Okay? We're looking at our entire debt. Okay? To see what course of action we should take. We have a holistic approach. Okay? We don't look at one debt by itself. In the case of Debt Snowball, this guy's looking at the lower balance by itself. Okay? Do not have a holistic approach. In the case of Debt Avalanche, this guy's looking at the higher APR by itself. Does not have a holistic approach. In the case of velocity banking, a lot of times These guys, at least on YouTube, this group likes to brag about how they're doing better, early on. Okay? But remember, again, we do not have no drag, which is the APR dragging us back. The APR will drag you back. Okay? Because imagine you're going to be paying a 10% interest environment when you have a 21 or a 26 on the board. Okay? That's the advantage of always attacking the higher APR first. Take away the biggest problem, which is the APR. Because remember, these are borrowed money, America. And interest is the cost of borrowing. Okay? This is our measuring stick. When you're paying off debt, that's the one you need to attack. Okay? America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. So now, from prior lesson, I told you guys that if you've been paying off debt using Debt Snowball, if you've been paying off debt using Debt Avalanche, if you've been paying off debt using Velocity Banking, America, you have been paying off debt incorrectly. You have been paying off debt not the proper way. Okay? So you need to move over to Ambroise Method 1.0. Okay? Ambroise Method 1.0, let me put that on the board. Okay? So with Ambroise Method 1.0, by the grace of God, I'm preparing a table before you, America, in the presence of your enemies called debt. Okay? Remember, this is where we are. 64% of us, again, is living paycheck to paycheck. 68% of us cannot come up with a $400 emergency. Okay? So, when you're paying off debt, you have to try to do things the proper way. Okay? And I've already shown you some of the deficiencies or pitfalls associated with the other debt repayment method. Debt Snowball, Debt Avalanche, Velocity Banking. Okay? And again, with Ambroise Method 1.0, I'm preparing a table before you in the presence of your enemies called debt. Okay? And I'm going to go one step further. I would love to see a day when I get my butt kicked by a debt snowball. America, I would love to see a day when I get my butt kicked by a debt avalanche. And finally, America, I would love to see a day when I get my butt kicked by velocity banking. It's not going to happen, folks. It's not going to happen. All right? It's never going to happen. Again, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0, our basic version. There is an advanced version that I'm working on, Ambroise Method 2.0, where we introduce more complex scenarios, more complex case studies. Ambroise Method 1.0 is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to Debt Snowball, Debt Avalanche, velocity banking. Thank you, Jesus. Until next time, America. Good morning.